Hey guys, it's Mrs. Invest. So why is it important to know how capital gains get taxed in Canada? Well, I think there's two main reasons. The first is if you are buying and selling assets throughout the year and you have a gain by the end of the year, the tax man is coming for you, and it's really good to know approximately how much this tax bill is going to be at the end of the year before you get it. So that way, instead of spending all your profits on horses and blow, you can have the money ready when the tax bill comes. And the second reason is when you can actually see how much more efficient and effective investment income is in comparison to working income when it comes down to taxes, and how much more money you actually get to keep of your investment income, it can be a really good motivator for you to keep investing, because you can actually see a tangible difference at the end of the year when it comes to your tax bill. So what is a capital gain? When you buy an asset and you sell it for a profit within that tax year, that is considered a capital gain, and you need to pay tax on that profit. And that asset could be a stock, an ETF, a mutual fund, cryptocurrency, or even a piece of real estate. So once you've sold that asset, then that triggers a taxable event, and whatever profit you've made on the sale, you have to pay tax on. And you might be thinking, oh, that's lame, I have to pay tax, that sucks. And the fact that you're even watching this video and you're wondering about the tax on capital gains means you are farther ahead than the majority of people. So think about it that way. If you're having to start to think about taxes and think about taxes on investment income, you're probably doing pretty well. And there's a lot of benefits to investment income too, as we're going to talk about soon. So don't be too sad that you have to pay taxes on your investment income. Capital gains can be realized or unrealized. An unrealized capital gain is where you are holding the asset. It has gone up in value, but you haven't sold it yet. So the fact that you haven't sold it yet means this gain is on paper only. You'll often hear it called a paper gain, or it's just theoretical. If in theory you were to sell this asset, you would have a profit and you would make money, but you haven't actually sold it yet. So the fact that you haven't sold it and you're still holding means it's an unrealized capital gain, and this triggers no taxable event. You do not pay any tax on this at the end of the year. Even if the stock that you're holding has gone up 1,000,000%, if you haven't sold it, you pay no tax. So a realized capital gain is when you've taken that asset and actually sold it to materialize the gain, and you now have created actual dollars that you can physically take and go spend on something else. The act of selling triggers the taxable event. That's a taxable capital gain, and you will have to pay tax on it at the end of the year. So how are capital gains taxed in Canada? Now, this is a way where we really differ from our American neighbors. They have short-term and long-term capital gains tax, depending on how long you've held the asset for. We do not have that. We have one flat equation, I guess you can call it, for calculating capital gains tax. And that is, here in Canada, we pay tax on 50% of the capital gain at our marginal tax rate. So what does that mean? So basically, when you go ahead and sell an asset for a profit, 50% of the profit is tax-free, and 50% of the profit gets added on to your income at the end of the year and taxed at your normal rate. So for example, if you make $100,000 a year at your job and you made $10,000 in capital gains that year, divide 10,000 by 2, 5,000 of that is free income, free profit, whatever you want to call it, and 5,000 of that 10,000 gets added on to your income at the end of the year. So at the end of the year, your total income on your tax bill would be 105,000. The 100,000 from working and half of that $10,000 capital gain. So how much you actually pay in tax on that 50% of the gain depends on two things. One is which province you live in, because the provinces have different tax rates. And two is your marginal tax rate, meaning how much money you make throughout the year. So if you are earning more in general income, working income, whatever your income sources are, your marginal tax rate is going to be higher than someone who earns less. So everybody is going to have a different marginal tax rate, and we're going to talk about that in a little bit. So there's 3 steps in order to calculate tax on your capital gain. The first step is to figure out something called your adjusted cost base. And this is a fancy term which basically says how much did you pay for the asset originally. So your adjusted cost base is your book value plus any commission fees incurred to obtain that asset. So book value means what you originally paid for the asset. So if you bought stock and you paid $5,000 total for the stock, all the stock shares, and $10 for your commission fees, that would be $5,000 9,000 plus 10, and that would be $5,010 is your adjusted cost base. The second step is to calculate your capital gain. So your capital gain is your selling price minus your adjusted cost base. So let's say your selling price was $6,000 and your adjusted cost base was $5,010. Your capital gain would be just shy of $5,000. The third step is to figure out what your marginal tax rate is on your capital gain based on your province and your income, and then apply that to your capital gain. So I'm going to put a chart up here, and I'll link down below the website that I use this chart from, and you can go on and find your province and find your income level and like go together and figure out what the tax is on any capital gains that year that you would get. So let's go through an example of how this all works. So let's say you live in Ontario and you make $100,000 a year in income. In 2019, you bought stock for $990 and you paid $10 in commission fees to acquire that stock. And now it's 2021 and you've gone ahead and sold that stock for $10,000. It's gone up a lot and you want to cash out and take your gain. So your adjusted cost base is the $990 you paid for the stock plus the $10 commission fee incurred to acquire the stock, and that's a total adjusted cost base of $1,000. So to calculate your capital gain, which is step 2, you subtract your adjusted cost base from your selling price. So $10,000 minus $1,000 is $9,000 for a capital gain. The next thing you have to do is figure out your marginal tax rate based on your province and your income level. So I'm going to pop a chart up right here, and you can see that somebody living in Ontario who has an income of $100,000, so that middle bracket, and you can see the middle column there is capital gains, and you can see that the capital gains tax rate for this person would be 21.7%. Now this is something really important that I think is a source of error a lot of times, and it can be a little bit confusing. That 21.7% applies to the whole gain. I know we were talking about earlier that we pay tax on 50%, but it applies to the entire gain. And I honestly feel like the people who created these rules were like, how can we make this as confusing as possible? So people just are so confused, they have no idea how to calculate this, and then they just keep working the rest of their life and never invest, okay? Because this is the explanation for it, so try and stick with me because it's confusing. So if you imagine your full marginal tax rate paid on 50% of the gain is equivalent to paying half of the tax rate on the entire gain. So that's how they look at it. So if you see the first column, that Ontario person, they would be paying 43% on other income at that $100,000 income level. So 43% or whatever it is there applied to 50% of the gain is the same as 21% applied to the entire gain. So that's the rationale for the tax on 50% of the gain. What it really is you pay half the tax on the whole gain, but the way they talk about it is you pay the full tax on half the gain. Do you get it? Have I lost you? It's like super confusing, but hopefully I'm making a little bit clearer here. So to calculate now the tax on that $9,000, you take $9,000, you multiply it by your personal tax rate for capital gains of 21.7%, and you get $1,953 of tax that you have to pay at the end of the year on that gain, which means you get to keep about $7,047 in profit, and you can take that profit and go to Louis Vuitton and buy a purse. No, we're not going to do that. We're going to invest the rest and reinvest it to make more money, right? We're going to do that. We're not going to Louis Vuitton. A way you can compare this tax rate is say, well, what if that person who's earning $100,000 a year made an extra $9,000 at their job that year? So let's say instead of making $100,000 working, you made $109,000. So the tax rate would be different here. You can go to the chart at that same person, but take the first column of tax, which is about 43%. So you would be paying $3,900 in tax on that $9,000 of extra working income, and you would be left with about $5,000 left over instead of $7,000. So that's a $2,000 difference in what you get to keep when it's generated from capital gains. And I think that's pretty significant considering we're only talking about $9,000 here. So 2 out of 9, that's like a fairly high percentage. And that's what I was talking about earlier in the video, is when you see how much more efficient investment income is, it becomes such a motivator to acquire more income in this way, because it's just better. Like, it's just better. It's just better. I don't know what else to say. It's just better. So that was just an example there of one single capital gain. But what if you've had many different transactions throughout the year and you've had many different gains? You made $1,000 here, $2,000 there, $500 here. Well, it's really easy. You apply the same 3-step formula and you just add up all your gains together and do exactly what we just did. So there's really no difference there other than just adding all the gains together. But what if you've lost money? This is called a capital loss, and this is when you sell an investment or an asset for less money than you originally paid for it. Now, losing money is never fun, but there are certain advantages that you can use to make the loss a little bit less painful, and this is called tax loss harvesting. At the end of the year, you add up all your capital gains, so the stocks or investments you've sold for a profit, and you add up all your losses, and you subtract them from each other to see whether you have a capital gain for the year or a capital loss. And there's really only 3 scenarios that are possible. Scenario 1 is you are net positive, so you have a net capital gain at the end of the year and you have to pay tax on that. Scenario 2 is that you're net neutral. Your gains exactly cancel out your losses and you pay no tax because you're net zero. And scenario 3 is that your losses are greater than your gains, in which case you can keep those losses and use them against future gains to reduce your tax bill in the future, or you can actually take those losses and go back up to 3 years and apply them to previous gains in previous years to reduce your tax bill that way. And this is kind of confusing. I wouldn't really recommend trying to do this yourself. You should probably consult an accountant for this. But those are the 3 really scenarios of how you can end up at the end of the year when it comes to capital gains and losses. And if there's a benefit of losses, I mean, nobody likes losing money, but if there's a benefit, it's that you can use those losses to offset the gains. So, if you make $1,000 in a gain and you make $1,000 in a loss, or you lose $1,000 in a loss at the end of the year, you are net zero, so you pay no tax on any of your investments. So they kind of work against each other. But losses you can carry forward a few years and up to 3 years back to apply them to any future gains. So that's one benefit, I guess, you can think about of losing money. So how can you reduce your tax bill on capital gains? Well, there's 3 main methods. The first one is tax loss harvesting. As I said, use your capital losses to offset your capital gains. The second way is to invest within your tax advantaged accounts, so your TFSA and RRSP. In these accounts, you can buy and sell assets within reason without triggering a taxable event. The RRSP, eventually you have to pay tax when you withdraw, but while the money is still in the account, you don't pay tax on the end of the year. And the third way to reduce your tax bill on capital gains is don't sell. Remember, you only pay tax once the gain is realized. So if you're holding a stock and you plan for it to be a long-term hold, it doesn't matter how much it's gone up. If you're still holding it, it doesn't matter how much gain you have in theory on paper, you pay no tax on that. So one way to ensure you never pay a capital gain is to never sell. So I hope you guys found this video helpful, that you learned something. Please like the video if you did learn something, subscribe if you are new, and any questions down below, I try to respond to all the comments. Try my best anyway. So I'll try to get back to you, and thank you so much for watching, and I'll see you in the next one. Bye.